In today's video, I'm going to reveal a supply and demand zones indicator that will help you to make massive profits in trading. As a trader, identifying high-quality zones might be a big challenge, and that's why I have decided to reveal this powerful indicator. So if that sounds interesting to you, kindly hit the like button, also subscribe, and turn on the notification bell to stay updated with our latest videos. Without further ado, let's get started. The name of this indicator is Multi-Timeframe Supply and Demand Zones Indicator by Flux Charts. Now, to add this indicator to your chart, you want to go to TradingView, then open any trading security that you like. Now, click on the Indicator Search tab and search for Flux Charts MTF Supply and Demand Zones. So, this is the all-powerful Multi-Timeframe Supply and Demand Zones indicator. Keep in mind that this is a premium indicator. So to get access, just click the link in the description below to visit Flux Charts and get this indicator with 7 days risk-free trial. So what exactly is this indicator all about? The Multi-Timeframe Supply and Demand Zones indicator is a powerful tool designed to print quality supply and demand zones on multiple timeframes with 2 different zone detection methods. These zones are commonly known as areas where there are lots of buyers or sellers present in the market. Now let's talk about the features of this indicator. Once you add the indicator to your chart, you will see green and red zones printed by the indicator. The green zones are the demand zones, which represents areas of high buying pressure, while the red zones indicate supply zones, which represents areas of high selling pressure. Now, when price retest a demand zone, the indicator will print an R label in green color, indicating a retest at that point. Similarly, when price retest a supply zone, the indicator prints an R label in red color and indicating a retest at the zone. Now let's look at the settings of this indicator. Just double-click anywhere on the indicator, and it will open the settings. If you look here, you can see that there are different adjustments you can make to suit your trading approach. The first thing here is the detection method, which includes momentum and regression. The momentum-based detection identifies key zones by analyzing rapid price shifts, making it highly effective in volatile markets. It works across all timeframes and is particularly useful for spotting opportunities when price makes a pullback. Conversely, the regression-based detection takes a more calculated approach by examining price balance and imbalance over time. This makes it ideal for consolidating markets where trends are less pronounced, helping traders uncover hidden accumulation and distribution zones. Choosing between the two depends on your trading style. If you focus on high volatility assets and trend trading, momentum detection is the way to go. If you prefer trading assets with lower volatility and want to identify areas where buyers and sellers gradually build positions, the regression method is a better fit. Another key feature here is the sensitivity. This gives the ability to adjust sensitivity levels to fine-tune how zones are detected. Traders who prefer frequent trade opportunities, such as scalpers, can opt for a higher sensitivity setting to capture smaller zones. Meanwhile, swing traders and those focusing on larger market movements may benefit from lower sensitivity, which highlights only the most significant zones. It's important to note that this setting applies only when using the momentum detection method. Next, we have the zone invalidation. To refine how zones are invalidated, the indicator offers 2 options. The first is a close-based invalidation, where a zone is invalidated or considered broken only if a candle closes beyond it. The second is wick-based invalidation, where a wick passing through the zone is enough to consider it broken or invalidated. Here's minimum zone width based on ATR. Increasing this will result in larger but less zones. We also have the minimum zone length. With this, you can increase or reduce the length of your zones, but it can only be from 10 and above. If you set below 10, which is the default, then the zone will not be rendered. Here, if you toggle on the breaks, the indicator will print a B label whenever price breaks a supply or demand zone. The indicator also gives an option to view multiple timeframes on a single chart, which eliminates the need to switch between different charts for higher timeframe analysis. For example, if you're working with a 15-minute chart, You can overlay zones from other timeframes to get a clearer picture of the market structure. For traders who want to stay updated without constantly monitoring the charts, the indicator also provides customizable alerts. These alerts notify you when new supply and demand zones are detected, when zones are retested, and when a zone is broken. Setting up alerts is simple. Just right-click on the chart. Select Add Alert. Set the condition to the MTF Supply and Demand Zones indicator. Choose how you'd like to receive notifications, and click on Create. Now that you have learned all the features and settings of this indicator, let's go over to how to trade with it and make consistent profits. The strategy we will be using to trade with this indicator is based on 3 key things. First is the trend. You have to identify a clear trend, either bullish or bearish. Secondly, we have supply and demand zones. If the trend is bullish, we will only be focusing on demand zones for buy trades. And if the trend is bearish, we will be focusing on only supply zones for sell trades. Then, finally, we have candlestick confirmation. When price retest any of our zones, we look out for a candlestick formation to confirm the setup before we enter a trade. Let's look at some real chart examples. Looking at this chart, we can clearly see that the trend is bullish, so our first criteria is met. Next, we can see that the indicator printed a fresh demand zone here, so we will be focusing on it to take a buy when price retests it. Now, as price pulled back to the zone, we can see that a green R label was printed, indicating a retest. But that doesn't give us enough confidence to buy. So we wait for our final criteria, which is a confirmation candle. And as we can see, price printed this bullish engulfing candle. So this particular setup is considered valid because all our conditions are met. So we take a buy at the close of the confirmation candle, set our stop loss slightly below the zone, and our profit target at 2 times the stop loss. And letting the trade run, we can see how price pushed up, hitting our profit target, and giving us a winning trade. Now let's look at a bearish example. On this chart, the market is currently bearish, and we can see this fresh supply zone printed by this indicator. Next, as price pulled back to the zone, it printed the red R label, indicating a retest. Finally, seeing this 2 consecutive bearish candles further confirms the shift of momentum, making this setup a valid one. So, with all this in check, we just open a sell position at the candle close, then set our stop loss slightly above the supply zone, and our profit target at 2 times the stop loss. And letting the trade run, we can see it was profitable. So guys, that's simply how you can use this indicator to boost your profitability in trading. Don't forget to check it out using the link in the description below. Also remember to backtest the strategy and practice it on a demo account to see how it works for you before using it to trade a live account. If you found value in this video, kindly hit the like button, also subscribe, and turn on the notification bell to stay updated with our latest videos. Thanks for watching, and see you in the next video.